What's been happening in Ireland is quite interesting because 5-10 years ago Ireland was seen as the poster child economy of the European Union, growing very fast, attracted lots of inward investment, the whole Celtic Tiger experience, so very, very buoyant, very, very optimistic country. Over the last few years though, everything has gone belly up. Had an enormous bubble in the housing market and the construction sector funded by lending from the banks. When the bubble burst, the construction sector found it couldn't sell the houses. The banks had a lot of bad loans out there to the construction sector, so the entire banking system ran into very, very big problems. And up until recently, again, Ireland was seen as a sort of model way of doing things. So they took very early action to control their budget deficit, and they announced quite a few packages of austerity, of spending cuts and tax increases. But in recent months, it's been quite clear that the banks are effectively insolvent. They're being kept alive on a day-to-day basis with money provided by the European Central Bank. And the pressure was building and building and building, and what are known as bond yields, the interest rates that Ireland has to pay on its debts, were going up and up and up. And it was fast becoming another Greek-style crisis where a country's debts come back to haunt it in the financial market. Well, at the end of last week, what happened was that the Irish started to have negotiations with the European Union and with the International Monetary Fund, which always comes in and helps countries out when it's going through these sorts of financial crises. So hit squads from both those organisations arrived in Dublin at the end of last week, and they got down to work pretty quickly because I think they realised that Ireland in 2010 was quite similar to the Lehman Brothers investment bank in 2008, that if you allowed it to go bust in a very disorderly manner, then there was a real risk of the panic spreading to other parts of the world. So I think that over the weekend talks were very intense, and on Sunday night there was an announcement by the Irish government that they would be seeking bailout money from Europe and from the IMF. George Osborne has announced that Britain will provide a bilateral loan to Ireland, which will probably be in the order of 7 billion, 8 billion pounds, probably around 10 billion euros. And that's for two reasons. One is that the UK is quite heavily exposed as an economy to Ireland. We export more to Ireland than we do to China and India combined from the UK. So we're obviously very big trading partners, so we've got some quite strong economic interests, but also RBS and Lloyds have big exposure to the Irish market, particularly their construction sector, and therefore I think the Chancellor here took a very cautious approach and said it's sensible to actually provide this loan to prevent the Irish banks and by a knock-on effect our own banks from getting into trouble. Ireland, I think, is going to have to pay a very heavy price for the loans. There will be another round of spending cuts and tax increases. The position for the Irish people and for the domestic economy is pretty bleak for years to come. Portugal is the next most vulnerable country, and the question is whether Portugal is going to be next in the fire, and I think it probably will be. With the bigger question there, does Spain become a target? Because Spain is a much bigger economy than either Portugal or Ireland, and if the investment community takes on the Spanish government and starts to push up Spanish bond yields, then that really will be of a bigger order of magnitude than what's happened so far. For the first time since the euro was set up a decade ago, it's conceivable to think of some of the smaller countries flaking away and actually deciding that life inside the eurozone is so painful for so long that they might be better off having a stab at life back running their own economies. And I think that it will really depend on how much pain is inflicted, whether the medicine works, and it hasn't worked so far in a country like Greece, so the portents there are not very good, and whether ultimately there's enough political buy-in from these countries to carry on for the longer term. And I mean, another issue is whether Europe has actually got the firepower to continue bailing out countries in this way. I mean, they set up a 750 billion euro fund together with the IMF back in May, and already the cost of bailing out Greece and Ireland looks to have taken up something like 200 billion euros of that. So they've already munched their way through almost a third of the bailout fund, and the question is if other countries find themselves in trouble, whether Europe has actually got the financial firepower to cope with what looks like a pretty structural crisis across the whole of the single currency.